Okay, so you want to own a SaaS company. No inventory, no warehouse, no trucks, no landlords, no perishable stock rotting in a walk-in cooler. You write the software once, and then you sell it to customer after customer after customer. And the cost of selling it to the 10,000th customer is basically the same as selling it to the first. Infinite margin, recurring revenue, work once, get paid forever. That's the pitch. That's the slide deck every SaaS founder shows a venture capitalist, and it's the reason software has produced more billionaires per employee than almost any other industry in history. Here's the problem. That pitch describes the destination, not the journey. And the journey is where almost every SaaS company actually lives and dies. Because a SaaS company isn't really a software business. It's a customer acquisition business that happens to deliver its product through a browser. And the moment you understand that difference, everything about how SaaS companies actually make money and how they quietly burn through millions of dollars of investor cash while looking like they're winning starts to make sense. Let's start with what it actually costs to build the thing, because software is cheap to build is one of those claims that's technically true and almost completely useless for understanding this business. Yes, code itself has no marginal cost. You can copy a file infinitely for free. But building a piece of software good enough that a business will pay you money every month for it, forever, is not cheap, and it is not fast. A genuinely useful SaaS product, the kind with real functionality, not a landing page in a dream, typically takes a small team of 2 to 5 engineers 6 months to 2 years to get to something customers will actually pay for. At a fully loaded cost of $150,000 to $250,000 per engineer per year once you count salary, benefits, and payroll taxes, that's easily $300,000 to $1,500,000 spent before you have a product that generates a single dollar of revenue. And that number assumes the first version works. Most don't. Most SaaS companies rebuild significant portions of their product at least once after learning what customers actually wanted versus what the founders guessed they wanted. Then there's infrastructure. And this is where a lot of first-time SaaS founders get a nasty surprise, because cloud computing bills scale with usage in ways that are easy to underestimate. Hosting, databases, and cloud infrastructure for a small SaaS company with a modest customer base might run a few $1,000s a month. That sounds trivial. But infrastructure costs scale with your customers' usage, not with your revenue, and those two things don't always move together. A customer who signs up for your cheapest plan but uses your product heavily can cost you more in server load than a customer paying you 10 times as much who barely logs in. Companies building anything involving artificial intelligence features have discovered this particularly painfully in recent years. API costs for large language model calls can turn what looked like an 80% gross margin business into a 40% gross margin business almost overnight if usage isn't priced and metered carefully. The classic SaaS assumption that infrastructure cost is a rounding error breaks down fast the moment your product actually gets popular. Now, here's the part of the cost structure that catches almost everyone off guard, and it's not engineering. It's customer acquisition cost. And understanding this number is the single most important skill in running a SaaS business, because it determines whether growth makes you rich or bankrupts you. Every SaaS company spends money to acquire a customer. Through paid advertising, sales salaries, content marketing, conferences, whatever the channel. That total spend, divided by the number of new customers it produces, is your customer acquisition cost, or CAC. Depending on whether you're selling a $20 a month tool to individual freelancers or a $50,000 a year platform to enterprise companies, CAC can range from under $100 to well over $20,000 per customer. Here's the number that actually matters, though: the relationship between CAC and lifetime value, or LTV, how much total revenue you'll collect from a customer before they eventually cancel. The industry rule of thumb, repeated in every SaaS finance course, is that you want your LTV to be at least 3 times your CAC, ideally higher. A business where it costs you $1,000 to acquire a customer who only ever pays you $800 before churning out is not a business. It's a machine for converting investor money into losses, dressed up in growth language. This is where SaaS gets structurally different from a coffee shop or a gym, and it's worth slowing down on because it's the entire logic underneath every SaaS company's spending decisions. In most businesses, you have to make a sale profitable in the same period you make it. The coffee costs you $1, You sell it for 4, you keep the difference today. In SaaS, the sale is often unprofitable the day it happens. You might spend $500 acquiring a customer who pays you $50 a month. You don't recoup that acquisition cost until month 10. Everything after month 10 is where the actual profit lives, assuming the customer sticks around that long. This is called the payback period, and a healthy SaaS company typically targets recovering CAC within 12 to 18 months. Push that payback period out further, and you need larger and larger amounts of outside capital just to keep growing, because you're perpetually funding the gap between spending money to acquire customers today and collecting enough from them to break even months or years from now. Which brings us to the number that defines whether a SaaS company survives long enough for any of this math to matter: churn. Churn is the percentage of customers who cancel in a given period, and it is, without exaggeration, the single most important number in this entire business model. More important than revenue, more important than growth rate, more important than almost anything else on the dashboard. Here's why. Imagine two SaaS companies, identical in every way, both adding 100 new customers a month. Company A loses 2% of its customer base every month. Company B loses 8%. That difference sounds small. It is not small. Run that forward 24 months, and Company A has built a substantial compounding base of paying customers, while Company B is running as fast as it can just to replace the customers leaking out the bottom, with almost no net growth to show for all of that acquisition spending. This is sometimes called the leaky bucket problem, and it's one of the most common reasons SaaS companies with genuinely impressive-looking new customer numbers never actually grow their revenue meaningfully year over year. A company can be closing new deals constantly, look busy and successful in every internal metric that measures activity, and still be standing still or shrinking, because the bucket is leaking faster than it's being filled. Churn compounds in a particularly unforgiving way over time, too. A monthly churn rate of 5% sounds tolerable in isolation. Compounded over a year, it means you've lost roughly 46% of the customers you started with, absent any new signups. Get that number down to 2% monthly, and your annual retention looks completely different. You keep roughly 78% of your base. That gap between 5% and 2% monthly churn isn't a rounding error in a spreadsheet. Over several years, it's the difference between a company worth building a career around and a company that quietly bleeds out no matter how good the sales team is. So how do successful SaaS companies actually fight churn? The honest answer is that the best ones design the entire product and business around it from day one, not as an afterthought once customers start leaving. Onboarding, how quickly and successfully a new customer gets to their first real moment of value inside the product, turns out to be one of the strongest predictors of whether that customer sticks around. A customer who never fully sets up the product, never connects it to their existing workflow, never gets a colleague to also start using it, is a customer who's mentally already halfway out the door the day their trial converts to paid. This is why so many SaaS companies invest heavily in customer success teams, product-led onboarding flows, and integrations with other tools their customers already use. Every one of those integrations is, in effect, a small extra cost the customer would have to pay in switching effort if they ever tried to leave, which quietly reduces churn without ever touching the price. Now let's talk about how the revenue itself is actually structured, because pricing model decisions here have consequences that ripple through the entire business for years. Most SaaS companies price around a handful of models: flat monthly or annual subscriptions, per-seat pricing that scales with how many people at a customer's company use the product, usage-based pricing tied to actual consumption, or some hybrid combination. Each of these creates a completely different revenue growth pattern. Per-seat pricing is beautifully simple and predictable, but it caps your revenue growth at the pace your customer's own headcount grows, and it can actively work against you if a customer's business shrinks and they lay people off. Usage-based pricing can grow explosively as a customer's usage scales, which is why it's become popular with infrastructure and AI-adjacent products, but it also makes revenue genuinely harder to forecast, because it depends on customer behavior rather than a fixed contract number. This is exactly why so many SaaS companies obsess over a metric called net revenue retention, which measures whether your existing customer base, on its own, is growing or shrinking in dollar terms. Expansions and upsells minus downgrades and cancellations, completely separate from new customer acquisition. A company with net revenue retention above 100% is, in a very real sense, growing even if it never signs a single new customer, because existing customers are spending more over time than they're losing to churn and downgrades. A company below 100% net revenue retention is running on a treadmill that gets steeper every year because it has to replace not just churned customers, but also revenue lost to downgrades, purely to stand still. Here's a hidden cost structure that surprises people who assume SaaS margins are simply high. Support and success staffing scales with your customer count in a way that's easy to under-budget in the early excitement of signing new logos. Every customer, regardless of how small their monthly payment, generates support tickets, onboarding questions, and renewal conversations. A company that signs a wave of low-priced customers without proportionally scaling its support team can find its support quality collapsing exactly at the moment churn risk is highest, during onboarding and around renewal time, which creates a genuinely vicious cycle where cutting costs to protect margin actually increases the churn that destroys the business's long-term value. Sales compensation is another cost structure worth understanding, particularly for SaaS companies selling to larger businesses rather than individual consumers. Enterprise sales reps are typically paid a base salary plus commission, and a fully loaded enterprise sales rep, salary, commission, benefits, travel, the sales engineering and management support structure around them, can cost a company $200,000 to $400,000 a year. That rep needs to close enough contract value to justify that cost many times over, which is exactly why enterprise SaaS deals tend to have long sales cycles involving multiple stakeholders, security reviews, procurement negotiations, and sometimes months of back and forth before a contract ever gets signed. A sales cycle that stretches from an expected 3 months to 8 months doesn't just delay revenue. It means that expensive sales reps' salary is being paid for months longer than budgeted before the deal that justifies their cost actually closes. Let's talk about the venture capital layer sitting on top of a lot of this industry, because it fundamentally shapes how many SaaS companies actually behave, and it's worth being honest about the mechanics. Because SaaS businesses often lose money for years while acquiring customers, they frequently raise outside investment to fund that gap between acquisition spending and eventual profitability. That capital comes with an implicit and sometimes explicit expectation: rapid growth, because venture investors are underwriting a portfolio where most companies fail, and a small number need to produce enormous returns to make the math work for the fund overall. This creates a structural pressure that doesn't exist in a coffee shop or a gym. A SaaS company can be perfectly healthy on a smaller, slower growth trajectory and still be considered a disappointment by investors who need outlier outcomes, which is exactly why so many SaaS companies chase growth at the expense of near-term profitability, spending aggressively on acquisition even when the underlying unit economics are marginal, betting that scale and future price increases will eventually make the math work. This dynamic produced one of the most instructive corrections in recent SaaS history. For years, particularly through the low interest rate period of the late 2000s and early 2020s, capital was cheap and plentiful, and SaaS companies were often valued and funded primarily on growth rate, with profitability treated as a problem for some future year. When interest rates rose sharply and capital became more expensive and harder to raise, investor expectations shifted dramatically toward efficiency, a metric combining growth rate and profit margin, sometimes called the Rule of 40. Which holds that a healthy SaaS company's growth rate plus its profit margin should add up to roughly 40% or more. A company growing 60% a year while losing 30% of revenue is below that bar. A company growing 25% while running a 20% profit margin clears it comfortably. That shift in what investors reward triggered waves of layoffs across the software industry as companies that had been optimized purely for growth scrambled to demonstrate they could also be run efficiently, sometimes cutting deeply into the very sales and marketing spend that had been driving their growth in the first place. So let's build the two honest scenarios for a mid-size SaaS company, because this is where the two very different versions of this business reveal themselves. In the optimistic scenario, you've built a product with strong retention, a healthy net revenue retention above 110%, a CAC payback period under 12 months, and monthly churn under 2%. Revenue compounds because you're not just adding new customers. Your existing base is quietly expanding through upsells and seat growth even before a single new sale closes. A SaaS company at $5 million in annual recurring revenue with these characteristics can often run gross margins of 75 to 85%. And once it reaches sufficient scale to spread fixed costs like engineering and leadership across a larger revenue base, net profit margins of 15 to 25% are achievable for a well-run, efficiently operated company. That combination, high margins, compounding retained revenue, and genuine operating leverage as the company scales, is exactly why software businesses can eventually generate returns that dwarf almost any other industry once they cross the threshold into sustainable, efficient growth. In the realistic scenario, a few unglamorous things go wrong that aren't exotic at all. They're the normal risks of this exact business model. Churn creeps up half a percentage point higher than modeled because a competitor launched a genuinely better product and a wave of contract renewals came due at the same time. CAC rises because the paid advertising channels that used to work efficiently get more competitive and more expensive as more SaaS companies bid for the same keywords. A key enterprise customer representing 8% of total revenue doesn't renew because their own business hit a rough year and cut software spending. Under those conditions, a company that looked, on paper, like it was compounding toward profitability can find its growth rate stalling while its burn rate stays roughly the same, forcing a choice between raising another round of funding at a worse valuation than the last one, or making the kind of cost cuts, often to the very engineering and customer success teams responsible for product quality and retention, that can accelerate the churn problem rather than solve it. None of this shows up as one dramatic failure. It's a slightly higher churn number, a slightly longer sales cycle, a slightly more expensive acquisition channel, compounding quietly month after month until the metrics on the dashboard look nothing like the growth story in last year's pitch deck. So does owning a SaaS company actually work as a business? The honest answer is that it works spectacularly well for the companies that get the unglamorous mechanics right: churn, payback period, net revenue retention, support scaling. And it works as an extremely expensive, slow-motion way to lose other people's money for the companies that chase growth while ignoring them. The margins really are extraordinary once a SaaS company reaches scale with healthy retention, but almost nothing about getting there is as effortless as build it once, sell it forever makes it sound. The software is the easy part. The business underneath it, acquiring customers efficiently, keeping them long enough to actually profit from having acquired them, and building a product people would genuinely miss if it disappeared, is where SaaS companies are actually built or quietly destroyed.